Hello and welcome to another video on how to secure yourself financially. So I'm gonna make again a quick recap of this beginner guide to financial statements where in this section they show you that if you're able to read nutrition labels or a baseball or soccer box score, you can learn to read the basic of accounting, basic part of a financial statement. And if you can follow a recipe or apply for a loan, you can learn the basic of accounting. And the basic, there are rocket science. So this section will give us basic understanding of how to read financial statement, much like a CPR class teach you how to perform basic cardiopulmonary resuscitation. This course won't train you to be an accountant, much like a CPR course won't train you to be a cardiac doctor, but it can give you confidence that when you're able to look at a set of financial statement, you can make sense of them. And after all, this financial statement, they show you the money from the Imoran Cuba Gooding Jr. lines from the movie Jerry Maguire, show me the money. It's like that's what it is. And you have four financial statements. The balance sheet that show what a company owns. Uh, Balance sheet show what a company owns and what it owes at a fixed point in time. The income statement that shows you how much money a company made and spent again over a period of time. The cash flow that shows the exchanging money between the company and the outside world, as well as the shareholder statement, or the statement of the shareholders that show the changing interest of the shareholders. And these sections only focus on the first three. So balance sheet, the TLDR is a snapshot of the company assets, liabilities, and shareholders' equity over a period of time. And assets are anything that a company finds and has with value, whether it's tangible or intangible. Liabilities is any obligation that a company has to pay for goods and service that they are providing. And the shareholders' equity would show is how much money the shareholders will receive if, for example, today all the company assets are liquidated and pay off all of its liabilities. So typically this is organized based on this formula. The assets are equals to the liabilities and the shareholders equity. So sometimes you might find that organized in that way, or you have all the assets listed at the top, followed by the liabilities and the shareholders equity. So, for example, Yahoo Finance used that layout. So, after all, the on the assets, these are generally listed based on how quickly you can convert them into cash. So you have current assets, which are an asset that a company expect to convert into cash within a year. For example, inventory and non-current cash, as well as uh, things that allow this company to operate that are not for sale, such as office supplies, equipment. Uh, then you have liabilities, which are less based on their due date, whether it's current liabilities that a company has to pay off within a year or less, or doing more than 1 year, aka long-term liabilities, as well as the shareholders' equity that show is the investor show the money that investor has put since the inception of the company, plus or minus it is earning. So then I look at the income statement, where after all this statement show you is if a company may or not a profit. Okay, and you can think of this statement as a set of stairs, again according to the SEC.gov, the beginner guide to financial statement. You can think of them as a set of stairs. When you start at the top with the total amount of revenue, and each time you go a step down, you make a deduction associated with that cost. And when you reach at the bottom of the stair, you know if a company may or not a profit. So typically you have is the total revenue, and then you make some deductions based on money that a company doesn't expect to collect from discounts or merchandise return, and then you reach to the net revenue once you make that deduction, to later on deduct from the net revenue the cost of sales. So how much money a company spends to produce the good and service, to reach to the gross profit. And then other deductions like operating expense associated to running your business, which are crucial for your daily activities, such as administrating salaries, marketing, research for new products, or improving existing one. Once you deduct that, you reach to the net income after operating expense. And now you have to deduct is the interest incomes, whether it's for a company ask for a loan or a borrow money, or whether it's a company uh, uh, ask for a loan or lend money. Okay, and the interest or the income uh, tax. This is money that a company owns to the government, based on how much money it receives, it generates, as well as a tax sale rate, or a tax rate. And then you reach if a company actually made a profit or not. And then the cash flow show, or the cash flow report is the company inflow and outflow of cash over a period of time. And this is important because, like people, company need cash to pay this expense or to purchase assets. So while the income statement can tell you whether a company generate a profit, a cash flow statement can tell you if a company generate cash. And it reads information from the balance sheets and the income statements. And at the bottom line of this cash flow statement show you is the net increase or decrease in cash, right? So that's great because cash flow review, or this statement review the cash flow from three different operations, or three different activities: operating activities, financing activities, and investing activities. So okay, that makes you a good sense of that. So the point of this is to now look at operating activities, what it does, and after all, what it does is to analyze the net income from the balance sheet and conciliate with the total amount of cash that was used or perceived from operating assets. So operating assets, whether it's uh, operating activities, okay, whether it's operating assets and operating liabilities, and the most common operating activities in terms of assets are inventory, accounts receivable, prepay expense, the money that a company or expense that a company incur for goods and service that are going to receive, such as premium insurance like car, vehicle, to protect those belongings from the event of any potential damage or accident, home health care or long-term care, such as home health care, nurse care, as well as the health for medical coverage, life in the event of the policyholder's death, liabilities, for example, lawsuits and disability that prevent you from working. And keep looking at other operating assets we have is intangible assets such as patents, exclusive rights to creators to manufacture and sell that over a period of time. So a couple examples here from Popular Mechanics website. You have is maglev, this um, electromagnetic inductive system for stabilization and suspension for ground vehicles, issued in 1969. GPS navigation system with satellites. So it's a navigation system using satellites with passive ranging techniques. The electronic device, or aka the iPhone, issued in 2007. The GPS patent was issued in 1974, as well as a CRISP gene editing tool issued in 2014. So trademarks, which are another type of operating activities in the intangible assets, which are words, designs that uniquely identify this company from the competition. For example, you have the famous quote from Michael Buffer, "Let's get ready to rumble." In copyrights, which are exclusive rights to provide to creator of original works to manufacture and distribute that invention over a period of time. So, for example, Twitter, Netflix, Spotify. Trade secrets, which are confidential data that a company uses to gain competitive advantage, okay, and perhaps even a monopoly, but that's a whole another story, based on process formulas or customer lists, as well as goodwill. And this is the brand recognitions, brand reputations, and um, customer list, or customer royalty. And there is a very thin line between to have a company that is to have a monopoly, or to have a company that is vastly dominate, in contrast to have a company that is better um, or that is new in the market. Why I'm saying that? Because goodwill is something that most companies thrive to achieve with the marketing, okay, or the revamp of that. In any case, then I keep looking at other operating assets. We have is the investment in affiliates, like limited partnership, which the investors or a company that purchase stock on this limited partner in return of control over the partnered assets and operations, equity investments, which are when a company purchases significant amount of stakes on the another company to potentially write its voice in the another management, the another company management decision. So here we have is Berkshire Hathaway, led by Warren Buffett, which is a multinational holding company. And this term is, well, a company, a holding company, is a company that engage through other business by owning them through stocks. So they don't engage directly in business, they do that through stocks. So Berkshire Hathaway, for example, uh, invest in a variety of sectors like uh, energy, healthcare, and retail. SoftBank, this is a Japanese conglomerate that invests in a variety of primarily technology companies such as WeWork, Uber, Airbnb. Alphabet, the parent company of Google, that again invests in a variety of technology companies. For example, Calico, this longevity company, and it is in Alphabet use it is venture capital arm, Google Ventures, to invest in these different companies. We also have is the Tech Pacific Group, which is a private equity firm that invests in a variety of sectors like retail, real estate, uh, and keep looking at other operating assets. We have is cash and cash equivalents. So these cash equivalents are, for example, money market funds, where these are funds that invest in very risky financial product with short-term or very risky short-term financial debt products, such as bank's debt or bank acceptance, certificate of deposit, which are savings certificate issued by banks with short-term maturity, commercial papers, uh, risky and unsecure corporate debt, as well as repo, these repurchase agreement, which are issued by governments, debt issued by governments. And then now, once I know at the most common operating assets, then look at the most common operating liabilities, whether it's accounts payable, money that a company owns to the suppliers and vendors, usually in a short term, 30 to 60 days, for things like raw materials, office supplies, service. And don't confuse this with accrue expense, which are expense that a company incur for goods and service that has been provided but not yet paid for. For example, wage and salaries, rent, taxes, utility bill. Also, I look at mm, yeah, accrue expense, defer revenue, which are obligations that a company has to pay uh, for good and service. Uh, it's an obligation that a company has to provide good and service for money that has been collected. For example, subscription service like Amazon, Netflix, Disney Plus, Hulu, or gift cards, right? Then I look at income taxes payable, which are money that a company owns to the government. Uh, they depend on the income and the tax rate. Okay, so usually in the United States around 21%. I think they lower that. This is data based on the 2021. And here you have a couple examples like corporate taxes or sales taxes, which are tax that is imposed in the production of goods and service. So, for example, like state sales tax or county or city sales tax. Also, the VAT, value added tax, which is a tax imposed in the production of goods and service at every stage of the supply chain. And ultimately, the customer pays the full VAT, but companies along the supply chains remit that portion to the tax. Excise tax, which are tax imposed on specific goods like tobacco, alcohol, guns, and gasoline, and something called the GST, right? This uh, GST, sell tax, good and service tax. This is good and service tax, which is that tax added to the value to the VAT in countries like Canada, India, and Australia. There's some detractor of that, but again, I'm just here to mention that exists. Then I look at the short-term borrowing, which is a type of debt that a company incurred to pay within a year or less. So you have um, bank loans. The reason why companies incur in those type of short-term borrowing is to meet their financial needs or to finance short-term projects, usually in a year. So, for example, bank loans, okay, to meet their working capital needs, they ask for a loan, and this working capital is the difference between the current assets, if you remember, assets that a company expects to convert into cash within a year or less, minus the current liabilities, okay, obligations that a company have to pay within less than a year. Uh, Bank loans, line credit, a ceiling provide to companies for asking credit or loans. Okay, line credit. If I looking at this, so yeah, bank loans, line credit, uh, trade credits, which are promise that a company set with the suppliers for good and service that has been received but not yet paid for, at, and they reschedule the next day to repay them. Mhm. The another This is another important, the withholding taxes, which is another income tax or taxable income. Mhm. Or income taxes payable. Income taxes payable. Yep, that's right. Income taxes payable. Mm-mm-mm. Income taxes payable. Mhm. Exactly. So short-term borrowings. So keep looking at the income taxes payable. So we have this corporate debt, sales taxes, and the withholding taxes, which is very important because this is a money that is deducted from the employee to the. It's a money is money that the employee deduct from the gross employees' salaries to pay directly to the government. And this is to promote the pay as you earn tax system to fight tax evasion. Okay? And after all, they're doing that because they're following is the same principle when they were, so for example, in the case of the US, they applied the same principle when they were 13 colonies. So the UK demand to pay them a tribute or taxes, and they ultimately say, well, no. And that's right. Hmm. 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 So yeah, so looking at the short-term borrowings like bank loans, a line of credit, okay, a commercial paper, which are short-term debt instrument issued by companies to meet their financial needs. Okay, trade credits, which are short-term financing using a trade credit, which allow company to defer payment of goods and service that uh, they have purchased from suppliers. Invoice financing. Okay, so trade credits are a way to defer the payment of goods and service they receive, the company receive from suppliers. You have trade credits. Like in other words, is hey, I owe you this basket of grapes, and I will repay you in the next month, right? No, the supplier says 2 weeks. Okay, the trade credits, invoice outstanding, which the company used outstanding invoice to raise capital from lenders, and based on this invoice and the value of this, the lenders provide funds to that. And the other are payroll advance. Again, all of these are short-term borrowings, bank loans to meet their working capital needs, bank loans, commercial papers, unsecured and risky uh, short-term instruments to raise funds to meet their financial needs, line of credits, which are a ceiling for ask borrow money, outstanding invoice. So the company shows outstanding invoice to lender, and based on the value of that, the lender uh, see if they can uh, give you the loan. And payroll advance, right? Payroll advance, which are, well, company can provide a shorter-term loans to employees that will be deducted in the next payroll. Or we did that will be deducted in the next payday. Okay, and then I look at notes payable. The subtle difference between this from short-term borrowing is that notes payables doesn't count the time. In fact, this is a promissory note, okay? And in Spanish, promissory note is a pagaré, all right? A promise. So this promissory note issued by the borrowers to a lender, el prestador al prestatario in Spanish. So this promissory note issued by the borrowers to the lender defines the detail of the loans and conditions. Okay, so the borrower agreed to pay that along with any interest and within a specified time frame. Okay, so here are some of the notes payable. So this note payable is a contract between the borrower and the lender to that outline is several conditions, and that outline the condition of the loans. Okay, so here you have bank loans, business loans, bonds, promissory notes, trade payables, installment loans. Okay, so bank loans, so they typically use this promissory note. That outline is the loan amount, the interest rates, repayment and schedule, and other terms. And then you have the business loans. So a company may borrow funds from other business or financial institution, such as private lender or venture capitalist. Okay. Bonds are debt security issued by corporations or governments to raise capital. So they represents a promise to repay the principal amount along with periodic interest payment. And the terms and conditions of the bonds are laid out in a bond agreement, which serve as a note payable. Promissory notes. Individuals or business may issue promissory notes directly to lenders. Okay, so trade payables. Company may renegotiate extend payment terms with their suppliers. In such instance, they may issue a promissory note stay in the agreed upon terms. Okay, and installment loans. So, for example, the first, okay, this note payable, okay, is an agreement between the borrower and the lender that outlines the condition of the loans and the agreements to repay them from the borrower to the lender. So you have these bank loans, okay. So when they outline is the loan amount, the interest rate, repayment schedule, among other stuff. Business loans is when the company wants to raise funds or borrow funds from other business or venture capitalists. Okay, like private lenders or venture capitalists, any other financial institution, private lender or venture capitalist. Bonds bonds are debt security issued by corporations or governments to raise capital, and they promise to repay the principal amount along with a periodic interest payment. And these terms and conditions are laid out in the bond. Promissory notes, which now are notes directly to lenders when borrowing money. Again, it outlines the terms of the loan, including the repayment schedule, interest rates, and make the notes payable. Trades payable is a promissory note starting. It's a promissory note with agreed upon terms with the suppliers. Interesting. With these bank loans, business loan, bonds, promissory notes, trade payable. So after all, okay, especially with this note payable, is a promissory note from the borrower to the lenders that agree to repay that based on the terms and conditions outlined in the loan. That you have bank loans where it outlines the amount, the loan amount, the interest rate, the repayment schedule, among other details. Business loans, this is for a company that wants to borrow money from other business or financial institution, such as private lenders or venture capitalists. Private lenders or venture capitalists. So the terms of the loans are documented in a promissory note, making it a note payable. Bonds, which are debt security issued by corporations and governments to raise capital, and again, they can issue or they issue a note payable. Outline is the term of the principal along the interest rate they need to pay for, and the rest in the repayment schedule. It's the same for promissory note, but now this is directly to the lenders, and the trade payables, which are a negotiation. Company may negotiate a negotiation to extend the payment terms with their suppliers. Okay, and then looking at the warranty obligation examples, which refers to obligations that a company has to repair or replace a defective product or a product that doesn't meet the quality standards. Doesn't meet the specified quality standards. That you have manufacturer warranty, extend warranty, service contract, part warranty, software warranties in vehicles. Okay, so that'll be all for this video. Take care. Bye bye.